Leverage. Now, leverage is a very important and big topic, and in a financial success, most and always it's done through leverage. And to conclude this, a leverage has simply can be defined with few words. That means you want to do more with doing less. So that's just right. Doing more with less is a definition of what leverage is. Okay, so we've talked about pip so far, and we've talked about the standard lot size, we've talked about mini lot size in our previous modules. So not many traders can put in $100,000 or $10,000 for one trade. So this is when they use the leverage, and this is where the Forex broker steps in. So simply, the business model of a Forex broker is to provide us. So broker is an entity which we use to trade. So you are the retail trader, and the broker is the Forex broker. So we will use leverage so that they do not need to give the whole 100,000 to trade one standard lot. So let's see this as an example and how this works. So if a broker provides a leverage of 100 to 1, so all you need to do is pay $1,000 to trade one standard lot, because 100 times 100 1,000 equals 100,000, because your broker provides leverage, which I'm explaining now, is 100 to 1. So you put in so broker leverage times you pay equals standard lot. So that means if you were to use you pay 100,000 and your broker puts in 100 times, and you can actually trade the 100,000 standard lot by yourself. Now sometimes this amount, this 1,000 is referred or called as margin. A margin is what you pay by yourself. Let's change that, and there's actually a formula in effect. Margin equals lot size divided by leverage. So for example, margin needed. So if I continue the example before, let's say the margin needed is going to be 1,000 because your lot size is 100,000 and the broker provides you leverage of 100, and this means this is how much money you will need to trade the standard lot leverage by broker, and this would be the margin, the money you put in yourself. Let's make that smaller. And you can also use this as a percentage amount, for example. Now these are in amounts, but if you were to do in percentage, sometimes the broker would show you in percentage. So let's have a look. So margin needed in percentage equals margin amount divided by lot size. So the margin amount given here is 1000. From here, as we can see, this is the margin amount. So I will write 1000, and the lot size, which is 100,000, because we're dealing with standard lot, and the percentage will be over here. It will be 1% equals margin needed 1%. Let's use this 100 1000 divided by 100,000. This is 1% in calculator, because I multiply by 100, it's 1%. So the margin needed is 1% in this case. Now in the same way, there are different brokers providing different leverages. And for example, a broker provides leverage of 50 to 1. Now instead of 100,000, you need to lay out for a standard lot of 100,000. You have to give, that's a margin of $2,000. That means if you want to trade this 100,000 lot, standard lot, you have to put in 2,000 by yourself, because the 50 times units is leveraged by the broker. And the broker is the party where you trade. So if I multiply that by 50, I should get 100,000. So let's have a look. 2,000 multiplied by 50 is 100,000. That means you can trade this lot by yourself by $2,000. So more leverage is provided by the broker, the better, because the less amount of money you have to put in yourself. Now it could be that you can make assumption, margin required, and leverage. So 5%, it's 20 to 1. We also did 1% is 100 to 1. There might be leverage for 3%, so 33 to 1. So the bigger the leverage amount, less amount you have to put in yourself. This is the amount you put in yourself, and this is by broker. Margin by yourself to trade different sizes of standard lots. Now these are for standard lots. Now if we think about this, we have to try to get a broker which has the highest number of leverage, because then you would have to put in the least amount of money by yourself, because the rest of the amount for the standard lot is put up by the broker.